Yeah, hi friends. My name is Sudhakar Prabhu and I am here to speak about stock investing using fundamental analysis. As a professional, I work as an investment analyst with a fund and my job is to do fundamental analysis. So, agenda for today: fundamental analysis, common terms, market capitalization, investment styles, stock classification, valuation methods. Then we have taken few examples and sector wise valuation. So first thing, intrinsic value. What is intrinsic value? Fundamental analysis involves finding out intrinsic value of a stock. And once you find that intrinsic value, you apply uh, various valuation metrics and then decide whether to buy or sell the stock. Intrinsic value is value of a company based on its underlying assets and liabilities and ability to generate cash flows over a period of time. To understand a company, one needs to also understand the economy, the industry in which the company is working, and of course the company. We'll have to look at both the qualitative and quantitative aspect of business. Quantitative aspect would be financial statements, ratio analysis, revenue and profit growth, assets and liabilities, and 10 years or 15 years track record of that company if that is an old company. And of course on qualitative factors would be business model, management style, how good is the management, corporate governance, etc. And also you need to compare the company with peers in the industry. Once you do that, you need to apply the right valuation metrics to arrive at intrinsic value. Now before going further, let us see few common terms which we'll use again and again in this presentation. Any financial fundamental analysis would involve reading various financial statements. Three would be balance sheet, profit and loss account, and cash flow statement. Balance sheet would consist of assets, liabilities, and net worth. Asset, as we all know, is something on which we can generate a return. So in case of a manufacturing company, the plant and machines, land and building, etc. would be asset, because you can use the machines for productive purpose and generate return. Liabilities would be money on which we need to pay interest. So for setting up of that plant and machinery or buying asset, you need to borrow from bank. So debt would be a liability. And of course, last is the net worth, which we also call the shareholders fund. Mathematically, it is simply the difference between assets and liabilities. The second statement which we need to look at is profit and loss account. As the name suggests, the statement gives the profit or loss from the operations. So on one side you'll have all the income, and on the other hand you'll have all the expenses. The balancing figure would be profit and loss from the operations. And last and the most important statement which we need to look at is cash flow statement. Business can show profit and loss in anything, but cash flow will actually show you whether the business is generating cash or not, because ultimately it is the cash which matters. Accounting wise, profit and loss account is okay, but cash is more important. So cash flow statement will give you cash generated from operations, cash raised and deployed in business. And also one need to read the notes to accounts. So few of the common terms which we use is equity outstanding. This is the total number of shares issued by a company. MCAP or market capitalization. This is a very important term. We have an entire slide on this. So simply market cap is price into total number of shares. EPS or earnings per share is calculated by dividing PAT divided by total number of shares. PE is price divided by earnings per share. Book value is total net worth divided by shares issued. PB or price to book is current market price divided by the book value. ROE, this is also another important term. According to me, this is one of the important criteria for buying or selling a stock. So mathematically it is calculated by PAT divided by net worth. Dividend yield, this is also another important term. Simply it is calculated by dividend divided by current market of price. So let's assume if a company pays 5 rupees dividend and the stock price is 100 rupees, so 5 divided by 100, yield would be 5 rupees. Then we have price to sales, which is your market cap divided by revenue. Then for simplicity's sake, I have put few numbers here. 1 crore is also we know is 10 million. 100 crore is 1000 million or 1 billion. 1000 billion is 1 trillion. For simplicity's sake, I have taken 1 US dollar as 60 rupees. So 1 billion would be 6000 crores. Market capitalization. This is a very important term. Most funds institutions use this as benchmark for buying or for identifying whether to enter a stock or not. So based on market capitalization, there are stocks can be classified into 3 categories: large cap stocks, mid caps, small caps. The overall market cap of US market is close to 15 trillion. So when I say US market, it would include all the stocks listed on the US exchange, all the stocks listed on the New York Stock Exchange. Similarly for India, the market cap is 1.2 trillion. So basically, if you take BSE index, the market cap of all the actively traded stocks would be close to 1.2 trillion. The market cap of only the Dow 30 would be 4,000 billion. The Germany's index is DAX. The market cap of DAX is 1 trillion or 1000 billion. Similarly, for CAC 40, the market cap is 1000 billion. In India, the BSE Sensex 30's market cap is 600 billion. Now large cap stocks. Internationally, if the market cap of any company is more than 10 billion, it is called as large cap stock. In India, it is more of 1 billion or 6000 crores. In large cap stocks, we also have mega cap stocks, where the market cap is 100 billion plus. Stocks like Microsoft, ExxonMobil, Apple, etc. are large cap stock. Microsoft market cap is 300 billion. ExxonMobil is 390 billion. Apple is 475 billion. Apple at the peak had a market cap of 650 billion. This is the largest market cap any stock has reached till date. In India, large cap stock would include stocks like Reliance, market cap is 40 billion, TCS, market cap is 60 billion, ITC 45 billion, Infosys 30 billion, and HDFC Bank 25 billion. Sheer size of these companies make them grow at steady state and are relatively less chance of blowing up. For example, TCS has profit of 8,000 crores. You can't expect profit to double every year. So 8,000 can't be 12,000 crores, but it grows at steady 20-25% rate. So these are large cap stock. These carry a significant weightage in the index. Stock like Reliance would carry, I believe, now 8 to 9%. Similarly, stock like Infosys will carry around 8 to 9% weightage in the index. As this carries significant weight in the index, most investors have to buy this stock. FIs, DIs buy these companies in their portfolio. See, all these large institutions generally benchmark their portfolio with the index. So any stock which is present in the index, they are forced to buy it. Then we have mid-cap stocks. Mid-cap stocks internationally, the market cap has to be between 2 billion to 10 billion. But in India, the market cap between anywhere between 200 million to 1 billion is considered as mid-cap stock. So in rupee terms, anywhere between 1000 crores to 6000 crores would be a mid-cap stock. These companies have relatively higher growth potential, where growth rate can be more than 20%. These companies tend to have higher P versus the market, largely because of higher growth rate. And if these companies are managed properly over a period of time, these have potential to grow into a large cap stock. Revenue range is anywhere starting from 1000 crores. So at some point these can become large cap stock. Small cap stock. Small companies which have market cap of less than 250 million are small cap stock. These companies are small in size and have potential to grow rapidly. The reason I have taken 200 million to 250 million is simple, because it depends upon the conversion rupee also. If it was 50, then probably the market cap would be 50 to 50 or 60. So that is why I have taken 200 to 250 million. In terms of rupee, any company with a market cap of less than 1000 crores would be a small cap company. Since these companies are in initial growth stages, they require huge capital. So every stage of growth will see dilution. They'll keep on coming to the market, raising money, IPO, follow-on public offer, anyways, any different ways they'll raise money. Most institutional investors can't buy these stocks, because most institutions have this benchmark that they can't buy a stock with a market cap of less than 200 million or 250 million. So that is why in many stocks we see, once the price reaches a particular point, we see suddenly the stock price jumps up. This is because many institutional investors who are sitting on the bench, who are waiting for the market cap to reach 200 million, just jump in and buy the stock at that point of time. These are promoter driven and may blow up over a period of time if it is not managed properly. And of course, those which will survive give us multi-baggers. Now, investment styles. Based on time period, we can classify investment into long only or relative. Then we have growth or value investing. Long investment also called as passive investment. Most of pension funds, insurance company follow this type. They study economy, and based on economic growth, they shortlist few companies which they feel which can grow securely over next 5 to 10 years. They just buy and hold this stock for years together. Since it is passive investment, they do very little buying and selling. They generally buy companies which pay dividend, which are large cap stock, generally stalwarts, which will grow better than the economy and can survive economic cycle. Key is surviving economic cycles and dividend paying. Since they don't trade, they can't make money on regular basis. So key is dividend paying. Generally, if you see pension funds from Western countries like US and Europe buy these companies. Interest yield in US is 1%, Europe is also at similar level. So if they find a stock which pays 4 to 5% dividend in India and which is a large cap stock, they just buy it, because the differential they get is 4% without taking much risk. Then we have something called as active investment or relative investment. Majority investors in stock market are relative investors. Though they say they are long-term investors, they are relative investors. They make money by buying stock and selling stock. Their aim is to earn a return relatively better than the market or competitors. They prefer industry which is growing better than other, but also in an industry they might buy a stock which they think will give a better return. For example, if today TCS has a better growth prospect, they might, and they have Infosys in their portfolio, they might sell Infosys and buy TCS. This is called relative investment. You compare two stocks and you find a stock which has better growth prospect and you buy it. And they follow strict price targets. As and when they get the price target, they sell and make money. My understanding is close to 70 to 80% people in the market are relative investors. Now, investment styles. Investment styles can be broadly classified into two categories: growth investing and value investing. Growth investing. In this, investors look at growth companies which can grow consistently over a period of time. Companies which can grow at a rate higher than peers in industry and give us superior returns. Generally, growth companies are valued on PE basis, and thumb rule is higher growth rate, higher PE, and higher stock return. This style is more relevant in a growing economy. When general economy is doing well, interest rate is low, environment is conducive for growth. Growth companies are generally valued based on PE basis, price to sales basis, and DCF basis. In India, companies like ITC, NBFCs, M&M Finance, banks, etc. are growth companies. In India, in fact, most of the companies will be growth companies, because in a growing economy like India or underdeveloped economy, the, the entire economy is growing. So you'll find lot of growth companies in India. And again, if you select the right stock, you can get multi-baggers. Value investing. Value investing is more for bargain hunters who buy valuable assets at cheap prices. This is more of a bear market strategy. Style is more relevant in bear market when market in general is being neglected by investors and assets are available at cheap prices. Investors buy good asset at discount prices, and as value of asset appreciates, he makes money. Involves lot of patience, as market may take long time to value asset. Valuation method used in this category is price to book, dividend yield. Since investor may have to hold the stock for long period of time, he may as well buy a stock which gives him some return in terms of dividend. Other valuation method used is replacement value. In today's market, asset plays like GVK, GMR, BAIL, Indian Hotels, etc. would be prime candidate for value investing. Stock categories. Before we look at various valuation methods available, it is very important to understand what is the nature of the stock, what is the quality of the stock. So any stock can be classified into these broad brackets. One is growth stock or value stock. In the growth stock, we have fast growers, stalwarts, slow movers. In the value pick, we have cyclicals, asset plays, and turnarounds. What are fast growers? Fast growers are stock which can grow consistently at 20% plus. Most multi-baggers are found here. These companies command a relatively high P and is darling of markets. Most mid-caps, small caps should fall in this category. In emerging markets like India, Indonesia, or any other Latin American countries, even large cap stocks are high growing stocks. In India, for example, TCS, HDFC Bank, HDFC Limited, etc. are still growing at 20% plus growth. So these are fast growers. Many of mid-cap stocks blow up during this phase. In pursuit of higher growth, they took undue risk, over-leverage, acquire companies at higher price, diversify, etc. But if they get the right strategy, these companies can grow into large-cap stocks. For example, Infosys from 2000 had a profit of 300 crores. In 2012, the profit grew to 8,000 crores. And if you look at the stock return, price has gone from 350 to 3000, so it become a 10 bagger. 350 is of course is adjusted for any stock split, bonus, etc. Similarly, TCS Bharti has been multi baggers. Bharti, for example, in 2004 had a profit profit of 1500 crores. This went to 9000 crores in 2010. Similarly, the stock has given a return from 150 to 1000. This is before bonus. Today I think price is 360, but this is a bonus adjusted. So 150 to 1000 return is almost 6 times. But we have exception to this rule also. Stocks which are fast growers but which are not managed properly can blow up also. We have example of Suzlon. Suzlon from 2005 to 9 profit has grown from 400 crores to 1000 crores. The stock has grown from 20 rupees to 300 rupees, almost 15 times. But look at the stock price today, it is I think close to 8 rupees. So if you take one wrong move, it can backfire. Suzlon did it by acquiring a company which was 2 to 3 times its size. It over leveraged and things went haywire. Similarly, Edgecom market cap has grown from 600 crores to 7000 crores in peak, but today the market cap is 200 crores. Again, a case of bad management. You try to go too fast in too little time, and we are not able to manage it. Stalwarts also are referred as blue chips. These companies are part of Sensex and carry heavy weightage. These are well established and financially sound companies. Product and services of these companies are high quality. For example, we all know ITC. ITC cigarette is, it's a world-class product. Everyone knows about it. Similarly, Infosys is a world-class company. TCS, HDFC Twins, Bajaj Auto are all stalwarts, and these product of these companies are well known. Fast growers which survive over a period of time can turn into stalwarts. Growth in companies generally is between mid-teens, but in case of developing countries like India, it can be 20% plus. Companies like HDFC, TCS are still growing 20% plus. When I say growth, I generally refer to profit growth. These companies are profitable with good cash flow, and generally they pay dividend. And I said earlier, blue chip will be mostly large cap companies, and most institutions have this in their portfolio. These are very well researched stocks, and return would also be almost similar. You won't have surprise in stock market. Returns would be steady. All these stocks have inherent strength, and even if they have bad times, they know how to survive and come back. This is the quality of stalwarts. Slow goers. Companies growing at slower rate than market or the economy. Companies which have reached large scale in mature industries have slower growth rate. In the past, these companies have been fast growing industries, but over a period of time they mature and slow down. Many fast growers and stalwarts over a period of time become slow growers. In the 90s, these companies may have been part of Sensex, but today these companies have lost relevance. Paper is a mature industry growing at 4 to 5%, but because of digitalization etc., consumption is not there. Similarly, textile is another matured industry and growth has slowed down. I have taken few examples. Balarpur Industries, Build, Century Textile, Bombay Dyeing, Hindustan Motors etc. were all part of index in 1990s, early 1990s. But over a period of time, they have slowed down and lost relevance. They are out of index. They command a very low PE, 4 to 5 times. Cyclicals, as the name suggests, the company follows cycles in the economy. Companies have ups and downs depending upon the economic cycle. All commodities like steel, metals, auto, airlines, hotels and are cyclicals. When GDP growth is high, demand for goods and services is higher. So does utilization, leading to higher revenue and supernormal profit. Because whenever the utilization pick up, these companies enjoy operating leverage. But when the cycle turns, demand falls, utilization is low, revenue can barely cover cost, profit falls, and some of these also incur losses. If timed correctly, many of these stocks can be multi-bagger, and if you time it wrongly or if you buy at a peak of the cycle, these can also be multi-beggars. So remember, multi-bagger and multi-beggar. Almost all cyclicals like Tata Steel, Tata Motors, all cement industries, all tourism industries, Indian hotels, Leela, Tata Motors, capital goods industries like Bale, Crompton Greaves are all examples of cyclical. They do very well when the economy is growing at higher rate. So 8 to 9%, these will all do well because demand for goods and services would be higher. So these will enjoy, these companies will enjoy operating leverage. The second type of category is value investment, value plays. So in this, first we have is asset plays. Asset plays are companies owning huge assets in their book, but the asset is not generating enough return. Due to slowdown in the industry or due to any other reason, the asset is not getting the valuation it deserves. Generally, in the market, if business has no profit, it will have low valuation or low market cap. But unlocking of these assets provide huge one-time opportunities. Asset plays are found in capital-intensive industries like hotel, manufacturing, commodities, etc. Return on these assets may be low, but as economy turns, asset may become profitable. A company may close down its old plant in city and relocate to some other plant. The land prices where old plants were located may have grown 100 times. Similarly, all hotels during downturn become asset play. Example would be Century Textile. Century Textile has a market cap of 2,500 crore. The debt in the books is close to 4,500 crore. It is a loss-making company. It has three main businesses. One is textile, which is doing okay. Cement is doing okay. Paper is loss-making. But if you just take the value of the asset which it has, the asset value, the land asset value is close to 10,000 crores. See, Century Textile is one of the most old textile company in India. It had many textile mills in lower Parel area, but over a period of time they have moved all the plants out of Mumbai, and these lands are lying vacant. So if you value these assets only the Worli area, that is I believe is close to 10,000 crores. So if you remove 10,000 crores, if you take the asset value of 10,000 crores, reduce all the debt, let us assume 5,000 crores, so only the equity value should be 5,000 crores. So it can be a multi-bagger, and business is free. Similarly, I have taken example of a mid-cap stock called Nuclear Software. Market cap is 280 crores. A company with excellent management, very clean, but no growth in business. Profit is growing only at 10-15%, but it has cash in its books of 280 crores. So if you buy it today, you are getting it virtually at cash value, and business is free. All these are asset play. Then we have turnaround stock. Turnaround stocks are stocks which have hit badly due to economic slowdown or company specific issues. Revenues have fallen down, PAT are down or are making losses. They have a high debt in their books. But businesses has inherent strength and potential to come back. When these companies turn, they again make multi-baggers. Sometimes change in management or just change in strategy can make wonders to the company. I have taken example of IndusInd Bank. IndusInd Bank from 2000 to 2008 was struggling. Profits were flat between 100 to 150 crores. Market cap was 1,500 crores. They had a management which was, I believe, little bit lethargic. So in 2000, at the end of 2009 or early 2010, a new management stepped in, and this company, this management was from a MNC bank, and were very thorough professionals with focus on growth and improving productivity. They have done wonders to the bank. Today the PAT has grown from 150 crores in 2010 to 1000 crores. Profit is up almost 6 times. Similarly, market cap has grown from 1000 crores to 21,500 crores. So it's like a 20 bagger. Sorry, it is stock is up from 40 to 425, so 10 bagger. Market cap is up from 1000 to 21,000 crores because they also raised lot of new money, new issue of shares. That is why the market cap is higher. But even 10 bagger is not bad, from 40 to 425. Okay, valuation methods. Now we have already understood different types of stocks, growth stocks and value stock. In growth stock, we found three different kind of categories: fast growers, stalwarts, and slow movers. In value play, we found asset play, turnaround, and cyclicals. Now it is very important to understand what kind of valuation metrics we apply to these stocks. Again, we have different kinds of valuation metrics. We have PE, price to book, price to sale, replacement value, DCF, and sum of the parts method. Now just look at PE. What is PE? PE is current market price divided by earnings per share. It indicates payback period, how many years it will take investors to get back the current market price. So let us assume you buy a stock which has a current price is 100 rupees, EPS is 10 rupees. So PE would be 100 by 10 times. So basically it indicates with the earnings of 10 rupees, it will take 10 years for you to get back your money. This is the most commonly used method by investors to value a company, as it is relatively easy to calculate. Generally, all growth companies' stalwarts are valued using PE method. Theoretically, low PE means undervalued stock and high PE means overvalued stocks. But in reality, PE can't be seen in isolation. It needs to be judged with other factors like growth, size of the company, and most importantly, ROE. Other factors would include leverage management, etc. Generally, P depends on growth rate of a company and industry. Company with higher growth rate will have higher P versus lower growth companies. That is why you'll find companies like Info Edge, Just Dial, which the industry believes are growth industries, will grow at higher rate, command higher P. I understand Just Dial is valued at close to 80 P. Similarly, Info Edge is valued at 40 P. Right or wrong, I don't know. That is what market perceives. Companies with also companies with higher ROE and lower debt will have high PE. That is why also if you look at most of the IT companies like TCS, Infosys, Sun Pharma, ITC, which have very less debt, which are growing at 20%, command higher PE of 20% plus. When I say higher PE, it is generally 1 year forward. Generally, market discounts earnings 1 year forward. So this is FY14. So FY13 is first FY13 is over. This is so market will discount FY14 earnings. So 1 year forward earnings. So 1 year forward, TCS is trading at 20 times. Similarly, Infosys is trading at 18 times. Okay, price to book. Price to book is current market price divided by the book value. Similar to PE basis, but instead of EPS, we put the book value. Again, theoretically, low price to book means undervalued, and high price to book means overvalued stock. In market, most banks, non-banking finance companies, highly leveraged plays like real estate, etc. Also, insurance companies are valued using price to book method. Also, asset plays, turnarounds, and cyclicals are valued using price to book method. This is because all these turnarounds, asset play won't have earnings to support the stock. So even if there is no earnings, market would value it at some price. Again, price to book cannot be seen in isolation. It need to be used with factors like size of the company, ROE, leverage, and of course most importantly, in case of banks and NBFCs, asset quality of the asset. Banks like HDFC Bank, IndusInd Bank, which are growing at 25% plus an ROE of 20% and which have excellent asset quality, have higher price to book compared to its peers. We have a chart of banks in the coming slides. I'll explain you in detail. Generally, higher price to book means investors are ready to pay a premium over the book for the quality and of the asset and sustained performance. Price to sales multiple. It's basically market cap divided by sales. So investors value a company based on sale multiple basis. Price to sale method is used for valuing generally startup companies which are in early stage of growth and has no profit. Investors believe that in startup initially there are cost and revenue is low, but if sales can grow faster than cost, then at some point in time it will become profitable and eventually start generating cash flows. If you track online companies or read news on minute basis, you'll find that recently a company called Flipkart, which is an online e-commerce company, was valued at 9,500 crores, 5 times sales. Its sales is 2,000 crores. It was valued almost 5 times sales at 9,500 crores. In fact, if you look at the market cap of all the retail companies listed in India, it is almost equal to 10,000 crores. So if you add market cap of Shoppers Stop, Trend, and other companies, Titan, etc., that itself it comes to close to 9,500 crores. Again, very risky method, as some startup may never have profit. You can keep on valuing companies on sales basis. Sales may keep on growing, but the company might never show a profit. So very risky. Generally these are used in PE investments. Replacement value. In this case, replacement value is your in this case, equity value is your replacement cost minus your debt. Replacement cost is setting up of a business at current prices. Cost of setting up similar business is estimated using current rates. Every industry has a standard way of valuation. For example, to set up cement it costs $125 per ton. So if you have a 5 million ton plant, the total cost of setting up of that plant would be 625 million. 125 into 5. Okay, so 125 million per ton. So value of a 5 million ton plant would be 5 into 125, 625 million. And assuming it has a debt of 400 million, so equity value would be 625, total asset value minus your debt 400 million, which is equal to 225 million. So 225 million would be equity value. So this is how we use replacement value. So in case if the market cap is less than 200 150 million or 100 million, it is just a steal, because equity value comes 225 and the current market price of that stock is 125 150 million. The current valuation would be lower because of various reasons. Maybe the economy is in a downturn, the market is not valuing the asset in the right way because the profit are low. But if you buy this asset and hold it, then at some point market will give the asset the actual value. Similarly, for a paper company it is $1,600 per ton, and steel I believe it is close to $800 to $1,000. Replacement method is significantly used in cyclical commodities and turnaround. Again, I have already explained this before, but again, normally companies are valued based on profit. So generally no profit, your market cap would be lower. But if businesses have no profit, there is value in asset or plant of the company. So if you look at even if there is no profit in companies like GVK, GMR, the stock is not quoting at zero price, because there is some value in the asset. That is why these companies are still valued. But the fear, okay, I'll explain later. Again, if a stock is at deep discount to replacement value, investors will jump and buy this stock, waiting for change in cycle. As cycle change around, plant utilization will improve, revenue will also increase, and so will profit. Discounted cash flow. In this method, present value of future cash flows are estimated using various estimates, and liabilities are reduced to arrive at equity value. Very complicated, as it involves lot of assumptions like rate of return, risk-free return, cost of capital, etc. Theoretically it is great concept, many finance guys swear by it, but I would suggest you to avoid it. Investment has to be very simple. If you use complicated ways to value the business, you'll get complicated number also. Sum of the parts. This method is used in valuing diversified companies which are involved in more than one type of businesses. In this, individuals are valued using any of the above methods and sum total to arrive at business value. So individual businesses might be valued on PE basis, price to book method, etc. Once you arrive the value of individual businesses, it is total to get sum of the part method, and of course you reduce the debt to arrive at the equity value. Most diversified companies like AB Nuo, ITC, L&T, Mahindra and Mahindra Finance, HDFC, ICICI Bank, Reliance, etc. are valued using this method because they have more than one line of business. For example, AB Nuo, in AB Nuo you have manufacturing businesses. You have in manufacturing they manufacture fertilizer, carbon black, insulators. They also are into textile manufacturing. Then they have various brands in their business like Pantaloon, Van Heusen, Louis Philippe, etc. So manufacturing companies would be valued using one method, brands would be valued based on other method. In AB Nuo you also have the insurance company, the mutual fund and the NBFCs. So each businesses would be valued based on different methods to arrive at total. And also AB Novo owns 24% stake in Idea, so equity value 24% market cap of Idea would also be added. Similarly, in case of ICICI Bank, it has insurance, it has securities, and mutual funds. So each asset would be valued differently. In case of HDFC Limited, it has stake in HDFC Bank, it has insurance companies, it has NBFC, it has another housing finance company called Group Finance. So all these would be added to arrive at value. According to me, this is also a bull market concept. Generally, when the markets are high, people use this method to arrive at all fancy prices. But I would suggest if you do some of the parts method in bear market, you'll find lot of assets worth buying. But remember, nothing in market is sacrosanct. A stock which was fast grower after a certain period of time can become a stalwart, and later it can also become a slow mover. Similarly, a cyclical can also become an asset play. It can also become a fast grower. So valuation method will also accordingly change. I have taken the chart of Infosys here, but I think next slide would be much better to understand. See, in this I have taken Infosys track record from 1997 to 2003. It had 1, 2, 3, 5 bonuses: 97, 98, 2000, 2005, and 2007. Infosys, of course, got listed in 1995, and most of us were still not in the market or had no clue about the market. At that time, market cap was 1100 crores, sales was 140 crores, and profit was 34 crores. Sorry, it got listed in 95, but the numbers which I have taken is of 1997. At the time when Infosys was listed, it was more of a startup company, very small. It was valued more on PE basis. PE, I believe, is 8 to price to sales basis, and the price to sales varied between 8 to 30 depending upon investors' perceived growth rate. By the way, Infosys IPO was devolved. When I say devolved, there were no investors ready to buy the stock. One very influential group came in and rescued the stock. They invested lot of money in the stock and made lot of multi-baggers. From 1997 to 2000, Infosys profit grew from 34 crores to 286 crores. So at that time it was valued on price to sales basis 8 to 30. In 2000 or 2001 we had this IT meltdown, but still in 2001 Infosys continued to grow. Look at the profit. Even in 2001 profit grew by almost 100 times. And from 2001 to 2009 it still continued to grow. Both sales and profit continued to grow. Price to sales become more reasonable between this period 2001 to 2010. Price to sales become 7 to 8 times versus earlier 8 to 30 times. Profit growth was more than sales, and it was valued more on PE basis. The PE was around 28 to 30 times historical, and forward I think it was almost 22 to 25 times. 2009 was an exception, so that is why PE was low. Otherwise it was always valued at 20-25 times 1 year forward earnings. It had a peak market cap of 2000 crores in 2011. The market cap which I have calculated here is using 31st March price, but this 200,000 market cap peak market cap was in between. Post 2010, profit growth has slowed down to 10 to 13%, and it is valued more as a stalwart and a mature company. So PE has also come down to sub 20%. And if who knows, and if profit growth falls further, or if profit growth comes below 10-15%, who knows, the stock might PE might also come down to 12-15 times. So the point I'm trying to say is nothing is sacrosanct. The valuation method used to value a company will also change. So same company might be valued on basis of price to sales, maybe PE basis, maybe as a price to book. So the point is everything is dynamic. Now to explain further, I have taken sector-wise valuation charts. I have tried to put how we use valuation metrics in different sectors and how we value stocks. Okay, IT companies. Uh, so first thing first, the first column is the company column, in which you have various companies. Second is the price. Third is O stands for outstanding shares in millions. Then market cap in rupees and US dollar. Earnings per share, I have taken 3 years EPS. 13 is the historical, which is already done. 14 and 15 is the forward earnings, 2 years forward earnings I have taken. Similarly, PE, which is your price divided by EPS. Then dividend, the dividend which they paid last year, FY13. Book value, price to book, return on equity, and price to sale. So let's take, I will take one example so it's very clear to all of us. First is TCS. Price is 2067. Total shares issued is almost close to 2000 million. So market cap is close to 4 lakh crores or 40,000 million. Then 40,000 million divided by 60, we have had market cap of 65 billion. 70 rupees is already they have achieved. If you read the balance sheet, 71 is their EPS. Then we have taken forward EPS 94 and 115. P is simple, the historical would always be higher, so generally we take forward 1 year forward EPS, or forward PE, which is 1958 divided by 94, that is 22 times. Dividend is 22 divided by 2000, 1% yield. Book value again 2067 divided by 225, 9 times. ROE again, we all know net worth divided by, sorry, price market profit divided by your net worth. Price to sale 6.4 times. Again in this I have categorized companies into 3 different categories. The first four are the large cap companies. Look at the market cap. TCS has 65 billion, Infosys has 30 billion, Wipro 19 billion. Then I have taken one company, Oracle Financial, which has market cap of 4 billion. This is a multinational company, so that is why I have taken it up. Then in the second category we have mid cap stocks, which include Mindtree, market cap is 950 million, Hexaware market cap 640 million, Persistent 500 million plus, NIT Technologies 250 million plus. And the last year we have 3 small cap stocks. Zensar market cap less than 200 million, Polaris again 215 million, and Nuclear Software 45 million. So look at the valuation difference. TCS as that companies in the higher tier has higher P, 22, 18, 20, 25 times, compared to the mid cap companies which have 12 to 15 times, and the last tier small cap companies have lower P. This is perfectly valid. A company to take an analogy, let's assume we go to buy a shirt. Let's assume we enter a departmental store wherein different kinds of shirts are available. So you enter the first category wherein shirts of branded companies or international brands like Van Heusen, Louis Philippe, Arrow shirts are available. These shirts will fetch you anywhere between 2000 to anywhere between 5000 rupees per shirt. But if then you move to the next block wherein you have shirts like Peter England and some other medium sized brands wherein the shirt is available at sub 1000 rupees. And then you go to the last category, which is unbranded shirts. Here you find shirts are available even at 250, 500 rupees. So that is the difference which the the reason for, so there is a difference between value of the price of the shirt in each different categories. There is a reason for it, and similarly the reason for different PE. Companies which have higher track record, better brand, will always command higher PE compared to your other peers. And look at the growth rate. Even these large companies are growing at 25-30% growth. So so if you want to buy a mid cap companies, then growth rate in this company should be higher than these large cap companies. If the growth rates are same, then why not buy these large cap stocks? So that is the reason for this difference in PE. But remember, if one of these companies can consistently grow 20-30%, then at some point these companies will have revenue or profit almost similar to these companies. So there is a chance that this PE might also expand. So this 12 might go to 20 times. But remember, it will happen only over a period of time. And you need to be extremely sure that this will happen. If you are not sure, then don't do it. And if the logic is simple, if these large companies are giving at 15-20% return, then these companies at least should give you more than 20%. I would say at least 40-50% return to buy this. If these are not, the mid cap companies are not giving 40-50% return, these companies are giving a 20% return, just buy these large cap stocks, because in case of downturn these have better chance of surviving versus these companies. One example I'll take here is Nucleus Software. Price is 85, market cap is 280 crores. As I already said earlier in my presentation, this company is available free. Cash itself in this business is 280 crores and P is 6 times. So this might be a chance of asset play, because some investors might be interested, because if business is free, they might acquire this company, give a hefty dividend and sell off the business. So this is one example. Then second example which I have taken is pharma companies. Again the headline remains the same. Again 3 tier companies. First is Sun, Cipla, Dr. Reddy, Glaxo, all with market cap of 1 billion plus. So these are large cap stocks. Then we have Cadila, Oakheart, Torrent, Tipca. These are also, I would say, semi large cap. Market cap is higher. Alembic Pharma, Unicam, FDC. These companies are small caps. Market cap is less than 500 million. PE is 15 to 10 times. Look at the PE again the same. The large cap stocks which are large in size and growth rate is better will always command higher PE. So 30 times, 20 times. The mid tiers are valued at lower PE, 17 times, 15 times, 19 times. Of course Oakheart is an exception, because Oakheart is facing company specific issue, that is why the valuation is lower. And lastly, the tier 3 companies, PE is low, 15 times, 10 times. So they are almost trading at, for example, Alembic Pharma is trading at 50% discount to Sun Pharma's PE. Even look at return on equities. All these stocks have very good return on equities, 20% plus. So these will command higher PE. Okay, FMCG companies. These are companies I believe most of you are very active in trading. ITC, Hindustan Lever, Nestle, Asian Paints, Godrej Consumers. Look at the very important point to look in this companies are return on equities. Look at the return on equities of these companies. ITC 33%, Hindustan Lever 134%, Nestle 47%, Dabur 35%, Colgate 100%. So all these company, many investors would always like to have these companies in their portfolio. To simply signify what does return on equities signify. So basically, let us assume you have 100 rupees with you. You go and keep it in your bank. If you get 9% return on it, 9% interest on it, so your return on equity would be 9 divided by 100, 9%. So here it means if you have 100 rupees and if you put in the stock of Hindustan Lever, historically if you had put it long back, your 100 rupees is generating you 134 rupees. So if you had put it long back, let's say 5 years back or 10 years back, that 100 rupees is on that 100 rupees you are getting 33 rupees on ITC, 47 rupees on Nestle. So that is why these companies are always preferred by investors and will have high PE. Look at the PE of these stocks. The forward PE is 31, 37, 31 for ITC, 37 for Hindustan Lever, 41 for Nestle, 38 for FMCG and pharma companies also called as defensive stocks. When markets are down and when markets are bearish, then investors will buy these stocks, because even in downturns these continue to do well, these continue to grow at 15-20% even in case of a bear market or general economy is not growing, because these companies generally sell essentials to people. Even if you are let's assume in case of a pharma company, uh, if you fall sick, whether it's a bear market or bull market, you'll have to go and buy medicines. You'll never say that, oh no, I don't have money, markets are bad, so I'll take medicines later. You'll have to buy the medicines. So these are all like essentials. These are companies which sell essentials, so whether good or bad market, these will continue to do well. Similarly, FMCG companies, they also sell essential commodities. And please remember, all FMCG companies are brands. For example, Nestle is a brand. Maggi, everyone knows Maggi. Similarly, Hindustan Lever sells various soap products. So these companies have brands under them. So brand command a higher value, because for example, let's assume you want to construct, you go to a carpenter, you'll find bottle of Fevicol there. You go to 10 carpenters, at least in 8 stores you will find Fevicol bottle there. Fevicol is manufactured by a company called as Pidilite, so brand. So that is why higher P. Two examples I would like take here is United Breweries and United Spirits. Look at the EPS, 7 times, 8 times, and look at the PE, 147, 115 times forward. So someone might say, why is it getting higher PE? Here the answer to this question is, here the stock is not valued based on PE of 115 times. In fact, the profit on these companies are very low because of inefficiency management. Market perceives that value of this company is much more than P. Let's assume we give 8, EPS is 8. We take the industry EPS of PE of 30 times, and if you multiply 8 by 30, 8 by 30, stock price should come to 240 rupees, but stock price is 1000 rupees. This is because investors are saying that the value of the business or the spirits or the breweries they have is much more than the stock price of the 240 rupees. It is close to 1000 rupees. So it is valued more on the basis of asset play. It is valued as more of business value rather than earnings value. Okay, power and engineering. This is the sector which is most neglected by the market now because of various sectoral issues. In the first, here we have all the power generation companies which are facing various kinds of issues. Look at the ease of earnings of these companies. EPS flat, no growth. Look at Reliance Power, 4 rupees, no growth, but still PE of 20 times. Tata Power, 3 times, 3 rupees, 2 rupees, degrowth of 2 rupees, 4 rupees. Look at PE, 36 times. Similarly, JP Power Ventures, 1 rupee, 3 rupee, 15 times. In this case, company, look at Adani Power, loss, but still there is some price to it. Stock is not negative. Similarly, Torrent Power, 10 rupees, this year loss, but still market is valuing it at some price. So in this case, all these are cases of replacement value or asset plays. Here the stock is valued more on the basis of asset, because market believes all that is happening in this sector, coal issues or SCP is not paying, state electricity board not paying the money, is short term in nature. Over a period of time, maybe next 3 years or 5 years, things will improve. These company will start generating returns. And even if you say, because this price is because the market believes, even if Reliance Tata Power sells all its assets, then it will at least generate 3 billion for its shareholders. Similarly, Reliance Power will generate 3 billion for its shareholders. That is what market perceives. But remember, once these companies start growing profit, all this will change. Similarly, we have two state public sector undertakings, NTPC and NHPC. See, look, when the sector is in deep difficulty, all the good companies also get affected. NTPC is India's largest power utility, 40,000 megawatt. It is one of the most efficient and well managed company, not only in Asia but one of the best in the world. But when sector is down, look, even these stock companies don't get valuation. It is valued at 12 PE, 1.5 times price to book, and of course the ROE is also low, 12%. Then we have last category, which is the capital goods manufacturing companies. Here we have BAIL market cap is 5.5 billion. Earnings, there is a degrowth in earnings, 27, 16, 12. So that is why it is getting low PE, 8 to 10 times. Price to book is also 1 to 1.1 times. But look, if sector turns around, and and you never know when that happens. So when sector turns around, and if we can see earnings growth, it can also command 10 PE. So maybe in future, if it is again able to show 20 rupees EPS, 20 into 10 times or 12 times, it can be 250 rupees. So two bagger. So one has to keep a close watch on all these companies. It's very difficult to time all these companies. Just need to buy and keep this. Yes, in the short term you might look like a fool. You might not get the return which you expect. But when it turns, it can be two bagger or three bagger. BAIL is also giving you a 4% return, 5 rupees EPS. So probably better than keeping the stock money in the bank. It is better to invest in companies like NTPC and BAIL. 4% yield, 4% yield. So it's all these companies would be good bet for insurance company and pension funds. So just buy this, and even if stock moves by 15-20%, 10-15%, you get 15 plus 4, 20% return. Okay, lastly I have taken banks, one of my favorite sector. In this again the heading is slightly different. Prices, outstanding shares, everything is in crores. Market cap, which is your price into outstanding shares. This market cap is in dollar, so this divided by 60. Adjusted price to book. As I already told you, all banks, NBFCs and asset players are valued based on price to book or adjusted price to book. So that is why I have taken price to book. So ICICI Bank has 1.6 times price to book, HDFC has 3.8, Axis has 1.5. Dividend yield, again simple, dividend this divided by price is a yield. I have taken earnings growth, FY 14 and 15. ICICI is expected to grow 15%, HDFC is expected to grow 27 and 28%, return on equity and ROA. So again, three categories. These are all large caps, 9 billion, 26 billion, 20 billion. These are mid-tier banks, market cap 2 billion, 3.6 billion, 1.7 billion, 6 billion, and these are all small regional banks, market cap 300 million, 600 million, 360 million. But look at the valuation difference. HDFC is getting 3.8 times price to book, IndusInd is getting 2.7, ICICI Bank is getting 1.6, Axis is getting 1.5. So you guys might have this question: why is ICICI Bank and Axis not getting higher valuation instead of being large cap stocks? Why is not getting 2.53 times? This is because they have quality issues. ICICI Bank and Axis Bank have a lot of money to infrastructure sector, a lot of money to power companies, road companies, and and market perceives that some of these assets might turn bad, or they will have to write this off. That is why lower valuation. Otherwise there is no reason why they should get higher price to book of 2.5 times. In this IndusInd Bank, again a brilliant bank, I already gave this example before. Excellent management, excellent asset quality, has higher price to book of 2.7 times. Even Yes Bank used to command higher price to book 3 times some month back, but because of various liquidity issues and asset mismatch in the balance sheet, the valuation has come down. Then in the last category we have small or regional banks. Here the growth rate is very volatile. Sometime you grow at 24%, sometime it shows loss. because last year their profit growth was down 50% in Karnataka Bank. This year they are saying 24%. Karur again this year degrowth and 10%. That is why lower multiple for these banks. Okay, to summarize, I would suggest buy simple companies which is easy to manage and more importantly understand. If you can understand companies which are simple, then you should buy it. Companies which can survive ups and downs in the economy. Most importantly, strong and honest management. See, business will have ups and downs, uh, but if the management is honest and professional enough, then they will be able to turn the company. But if you have a very poor management, then even good businesses won't survive. Businesses which are sustainable and can grow over a period of time. And this is the third is businesses which have very high ROEs and can maintain it. I already explained you what is ROE. ROE basically means if you keep 100 rupees in the bank, interest rate is 9%, you get your ROE is 9 ROE. So basically you should look at companies which have high ROEs of 18 to 20% range plus, because 9% anyways you are getting in the bank. 9% you get risk free return. So if I get in 12-15% ROE companies, it's no use. 3% for the additional 3% return you are taking risk, because in equities the stock price can also go up to zero. So you should buy companies which have higher ROEs, 18 to 20% plus. And once you identify companies, apply appropriate valuation metrics. And lastly, I would suggest don't mix technical analysis and fundamental analysis. If you buy a stock using technical analysis and if you go wrong, don't apply fundamental analysis, and similarly vice versa. If you buy a company using fundamental analysis and if you go wrong, don't apply technical analysis. Analysis. So thank you friends, thanks for your time and patient learning. I'd also like to thank you all guys for listening to me. If you have any questions, I am open. You can put it on the chat. Thank you. Thanks. Bye.